How to tax the rich. So this conversation is a little tricky because the rich have lots of ways to diversify the way that they handle their money, and they spend lots of time and energy hiding that money from people who could take it from them. So if we think we should, so first, it's helpful to understand how it is the rich store their money and how they protect it from tax. So the first and most obvious way is just to ship it to an offshore bank account, right? To have a bank account in the Cayman Islands or in Panama or some other country that doesn't charge taxes the way that we do in the US, and just send their money there, right? The second way that individuals who are incredibly wealthy hide their money is they do it in assets. So they buy houses, they buy buildings, they buy hotels, they buy boats, they buy cars, right? These are all methods for the wealthy to hide their income and to hide their money. One of the ways that the rich are very good at hiding their income is that they incorporate themselves. It's not them getting paid, it's their company getting paid, and they just, they have business expenses or what have you. They use these shell companies to play games, essentially, where they can move the money around and then it gets lost. And it becomes almost impossible for the IRS to track. By the way, this is one of the reasons that the IRS very rarely audits rich people, because it's very difficult for them to track down where all this money is, because it's either constantly moving or it's moving out of the country and things like that, right? There's a whole mess of ways that the rich hide their money. So how do we counter that? How do we tax the rich? So definitely one of the ways that we tax the rich is to increase the amount of money that we collect from all capital gains that are made, like I talked about in the last segment. But there are some other ways too. So one would be a lever's tax. So a lever's tax essentially says anytime that you move your money offshore by some mechanism or another, that money is taxed at a certain percentage. And you would want that percentage to be fairly high, almost high enough to be punitive. And the reason you do this is to encourage that money to stay domestically. It's important for that money to stay within the country, because then it can benefit the economy in that country as opposed to being held somewhere else or benefiting the economy of another country, right? So there's actually a national interest in having a lever's tax that's very high. We're also going to talk about a lever's tax when we talk about corporations, but the context is a little different. So so that would mean that any time that money is being transferred digitally, and remember that most money is digital nowadays. Your bank account may have some number of dollars in it, but you're almost never going to have that amount of dollars on your person. And given the time value of money and how most banks will give you some level of interest for your money, it is almost guaranteed that putting your money in a financial institution that is interest bearing, even if nominally so, is always going to be a better investment for you. But that aside, so anytime that this money transfers digitally to another location, the bank is forced to withhold some of that money for tax purposes. And again, you want that number to be very, very high. And you can use marginal tax rates for that too, right? You can say up to a certain amount of money, transferring it offshore is very cheap, but anything more than that will be more expensive, and you can create iterations and yada, yada, right? There's a whole mess of ways you can do that. But so the first way to do that is a lever's tax. The second way to do this is a luxury goods tax. Now, if you think about luxury goods, we may be talking, luxury goods are not always the same to everybody. So when I'm talking about luxury goods, I'm talking about incredibly expensive things like cars, boats, luxury RVs, things like that. Now, this may include things like $5,000 handbags or whatever, or very expensive fur coats, right? It will be up to a regulator to determine what types of items classify as luxury items. But generally we have a sense of what a luxury item is, right? It's an item that's very expensive for its class of products. Maybe there's some maybe there's some statistical way to tell if something's a luxury item versus a non-luxury item, right? Like a $3,000 bed versus a $500 bed or something like that. The point is, this would all have to be done. There's some level of interpretation to be done there. But so if you implement a luxury goods tax, and again, make it fairly high, you reduce the amount of luxury goods being purchased. And although the argument may be that, oh, well, if the rich are purchasing luxury goods and that money is going into the economy and it's benefiting the workers who make the thing, and I hear you. But if you balance it correctly, you can reduce the number of luxury goods being purchased just enough so you're not stopping them from buying luxury goods, right? There's a good chance that no matter what the tax on a luxury good is, the rich will still buy it, because oftentimes these things are status symbols and they're more about our psychology than they are about our wallets. But there's a way to meddle with the numbers so that you can essentially figure out how much the rich would be willing to pay extra for the luxury good. You put a tax on top of that. Think of it like a sales tax, but instead of impacting the poor, like most sales taxes do, this would be a sales tax to the rich. This can also apply for things like assets. Now, the tax wouldn't be like a luxury good tax, but it would be, you could have, for example, like a second home tax, or a tax that is specific to buying assets, right? So if someone is making their money and they decide they're going to invest in a business, they're going to buy a business, right? Maybe we allow for the first individual to, the first business they buy to be tax-free or tax low, right? But after that, you can make the taxes increasingly high up until the punitive amounts, so that there is less monopoly and oligopoly control of these businesses and these assets and things. This is especially true with housing, where the rich and development companies are using their vast sums of assets to buy lots of developments and to rent them, as opposed to allowing regular people to buy homes. I talked about this an episode or two ago about the international housing crisis. So this is another way we can tax the rich, right? Create an asset tax. Again, this will have to be on regulators to figure out how much this money should be. But essentially, what we're trying to do here is we're trying to take the standard money-hiding behaviors of the rich and tax them, and sometimes punitively, because the truth is, it's oftentimes the case that we do not want these behaviors to persist, right? We don't want rich people buying homes that they're never going to live in and taking them off the market and causing the housing prices to rise for regular people, right? We want to stop that behavior. We want to stop the rich from sending their money offshore, from incorporating themselves and essentially playing a shell game with small corporations so the money can never be traced, right? There are behaviors that we want to limit, and we can do that through taxing. And when we do that, we begin to collect a lot more money from the rich. And once we do that, what happens is the tax burden shifts, because you no longer need to collect as much money from the poor and the middle class in this country and in all countries once you're collecting more money for the rich. This has a number of benefits. The first and most obvious benefit is the poor pay less taxes, which is good because they don't have much money. The second benefit is the more money you take away from the rich, and because in a capitalist system money is power, the more power you take away from the rich. And you begin to re-democratize our systems, because they can use their money to leverage political power, whether it's donations or fancy gifts or corporate lobbyists or whatever. There are ways that the rich have to influence the political systems. And it's because they have lots of extra money lying around, they don't know what to do with it. Or they do know what to do with it, and sometimes that's more dangerous than them not knowing what to do with it. But the truth is, we can create more democracy by limiting the amount of inequality we have. And the third benefit is, once there's more money coming in from the rich, less money coming in from the poor, not only do we reduce the amount of inequality, but we can also begin to justify more redistributive practices. So large-scale public safety net plans, right? Things like that, where there's no more of a worry about who we're impacting. And also, we can create more universal programs, which the rich will benefit from, but obviously not as much as the poor will. So I hope I've outlined for you, with the help of my previous segment about labor income tax and capital gains tax, how it is that we can tax the rich and what the benefits of that are for regular people generally, but also society as a whole.